Hey folks, welcome to Quantsapp and welcome back to yet another video. In today's video, we will learn something really interesting. So we will learn how you can go ahead and identify bulls and the bear traps happening out there in the market. So we will learn how you can look at the options open interest data and you can easily figure out that, okay, this is the stock where bears might get trapped. This is the stock where bulls are getting trapped. So how you can identify such data points is something what we will learn today. And also we will learn how you can go ahead and deploy the right strategy whenever such type of traps happen in the market. So let's first understand, how a bear will get trapped. Okay. So let's say for an instance, there is a stock. Okay. And the highest call writing wala strike, the highest call OI strike is this. Okay. Whatever the stock is, stock's name doesn't matter, price doesn't matter, the concept is. Right. So let's say the highest call open interest strike price is placed at this particular level. And people sold a call option, and let's say they have a peak profit of, let's say, 20 rupees. Okay. That someone sold this call option. A lot of people sold this call option and they received a premium. So whenever you sell the option, you receive the premium, right? So participants who sold this option, let's say they received around 20 rupees by selling this option. And which is this strike, by the way? This is the highest call open interest strike price. So this strike has the highest stake of call writers. What is the call writer stake? What is call writer's forecast? Call writer is a bear. What call writer is thinking? Call writer is thinking that the underlying price might not go above this level. Till the underlying price is not going above this level, he is okay. He might not be worried. The reason being his option is still out of the money, right? So let's say this is the 1,000 strike price call. Okay. And let's say the instrument is trading here somewhere at 90, right? So that this option, right? This option does not have a lot of intrinsic value when it is, or it does not have any intrinsic value to be precise. But 980 is the price where the stock is trading right now. So this option does not have any intrinsic value. So most probably, most of these call writers, they will be sitting on a profit. So what might happen is the instrument might start moving higher, and it might take a stiff resistance where the highest call writers are sitting, right? So they are creating a resistance, not letting instrument to surpass this. But one fine day, what might happen is the stock might move up, right? And let's say on this day, the stock has went up to 1,050. Okay, just a random example just to make you understand the concept. So let's say the stock has moved to 1,050. Now same strike price call option, which was quoting at 20, how much it would be? At least 50 minimum, right? Intrinsic value at least would be 50 plus the time value. Let's say the time value over here is 10. So still that option would be quoting around 60 rupees. So now what happens is, what idea is over here, that these call writers who had just 20 rupees to win, what they will do when their option has turned to 60, they sold the option at 20. Right now their option premium is 60. What is the way through this position, right? And they know that there are so many people who might face the same thing. So one thing that will come to their mind is exit. What do we call it? A short covering happening on call. All these call writers who have sold at 20, their option has turned to 60, right? Roughly, I'm talking just for an example. It is not an actual calculation. It is just for an example. But the idea is, जो जिसने 20 पे बेचा उसका 60 हुआ है, what would be the actionable for him? Just go ahead and exit the market, right? Just go ahead and exit the position. The reason being, there are so many call writers who have created the same position. There are so many bears who have created the same position. There might be a panic that if the stock moves up even higher, this might turn to 100, this might turn to 200, God knows, right? So what would be the simplest adjustment over here? I would not even call it an adjustment. What would be the simplest exit or simplest way of saving ourselves from an upcoming profit and upcoming loss in this scenario is, you just go ahead and cover your sold call, whatever the loss is, you book the loss and exit, right? And due to which a big short covering would happen, right? Because everybody will go ahead and copy the same position, everybody will go ahead and exit the same trade, and there would be a short covering happening on call option. So all these call writers, they will do, they will go ahead and create a new strike price, they will go ahead and shift their position to a higher strike, and that is how a trap happens. So how a call writer will get trapped? So how a bear will get trapped? So a bear will get trapped whenever he creates, whenever everybody in the market is creating the same position. That means a lot of bears are having stake at that point. Number one. Number two, the moment stock gives a breakout, and few people start unwinding from there, right? People start to go ahead and shift their position. That is the time a stock has more room to move in the upwards direction. First, this was the resistance. Stock gave a breakout, call writers unwinded, and they created a resistance here. So stock has more move to move in the upwards direction. So this is how a bear will get trapped. So to summarize, what happened is when 20 rupees wala option turned to 60, you know, not a lot of bears will go ahead and hold that position. Instead, they will go ahead and cover it. Short covering will happen on call, and the entire market might possibly copy the same trade, and there would be a huge short covering happening on call, and all these call writers might move to an upper strike, right? And this is how a trap happens. A bad trap happens. How a bull trap will happen? A bull trap will happen opposite of it. So I will not invest a lot of time in this. So let's say a bull trap, how it will happen. So what is bull positions? How will a bull create trade in options market? Let's say a lot of puts are getting sold. So whenever a put writer is writing, he is expecting the instrument might not go below that particular zone. So now what happened is, let's say this is how the stock behaves and all these put writers are sitting on a profit. Now one fine day, the instrument might collapse from here. And again, the exit point for these put writers would be, because these puts, right? These put writers are sitting on a loss. These bulls, they are sitting on a loss. So what they will do? They will go ahead and short cover their put option. So there would be a short covering happening on put option, due to which the support might get broken and there might be a down move happening in the instrument. So when a call writer will get trapped, to summarize, whenever the stock goes above the highest call strike, that is where the call writer will get trapped. When a put writer will get trapped, whenever the stock goes below, right, below the sold put. So a bear trap will happen when the stock goes beyond the strike price where the highest number of bears are participating. When will the bulls get trapped? Whenever highest number of bulls are participating at a particular level, whenever the instrument drops below that, that is where the bulls will get trapped. So now I have explained you the concept. How you can find it out is, you can use the option chain tool in the application, which will help you in identifying the stocks around the highest call, or it will show you the open interest data. So over here you can see this is the open interest. So this is where the highest call OI is, and if you just look at this, so this is Nifty's option chain. So the interesting fact is 18,200 is the strike price, where the highest call or significant call and significant puts are. What does that indicate? That indicates that if Nifty gives a breakout from this 18,200, right, then we might see a good move happening to 18,300, right? Why we are discussing this is because just look at this. This is where the resistance is. But what is happening? The moment Nifty moves above 18,200, right? Let's say 18,250, all these options, like the call option premium will go up, and all these call writers who have sold it, most likely is the chance that they might unwind and there might be a good move happening on the Nifty front. But where the second immediate hurdle or second immediate pause is placed at 18,300, right? So my interest is not over here where there is not a lot of open interest. Okay, where my interest is, where there is huge participation happening, where a lot of bulls and bears have created the position. Over there is where only the trap will happen. A trap will not happen everywhere because there are not a lot of bulls or bears participating in it. So let's say Bank Nifty. But the thing with this is, so Bank Nifty is trading above the highest call open interest strike price. 43,000 is the strike price where the highest call writers are. But what it is trading above the highest call. So the movement, now if you see the bracket, it is showing you addition or unwinding. So participants are not unwinding in Bank Nifty as such, right? So the moment you see that they are unwinding, then again in Bank Nifty we might see a good move happening on the upside. But now, right now, see what the current position tells you, that call writers are not getting trapped. The bears are not getting trapped. How can we come to know? We can come to know by seeing unwinding in OI. So two things what you need to find. First thing, highest call strike, stop trading in the vicinity or slightly above the highest call, number one. Number two thing, the open interest should unwind, the call writer should unwind. Only that will indicate you that okay, the bear's trap is happening at that particular point, as simple as it gets. So now the thing with this is you can't go ahead and do it for all the FNO scripts, right? So now what is with Bata India? So with Bata India, the thing is that if you see 1700 is the strike price where the highest call over is, right? So till Bata India does not break 1700, so there is not a lot of action happening in Bata India for us, right? That is as simple as it gets. So first thing that you want is Bata India to surpass and sustain above 1700 and these call writers to unwind because there is no resistance which can create a barrier on the upside. So, but the problem again over here is you can't go ahead and find those stocks out one by one. So BL, so see BL is something which tells you that okay over here what has happened is 100 strike price is the strike price with the highest call open interest, right? And all these call writers have unwinded. First thing. Second thing, if you notice in BL what has happened is a lot of puts. So the bulls are creating the position at the ATM itself, right? So the support is getting stronger and the resistance is getting weakened in B, right? So we might see BEL, the next hurdle is standing at 105 straight up. So I will show you a simpler way of identifying such stocks. You can use the tool of option triggers, right? And you can select the monthly expiry, obviously, right? If you want to go ahead and identify the stock. So this thing will tell you all the strike prices, right? It will show you all the strike prices, or I would say all the stocks with the highest call and the highest put, which means that it shows you where the highest call open interest is and where the highest put open interest is. So let me just give you an example. ABFRL, its highest call is quoting at 300, its futures price is quoting at 289, and its highest put as well, it is placed at 300 ka strike price, right? So another thing what this thing tells you is the call difference. Now it tells you how far your stock is from its breakout level, how far the highest call is from its futures price. It is shown to you by call difference, right? So over here ABFRL is 3.7 percentage away from its highest call. 300 and 289 ka difference is something, in this case 3.7. So call difference is nothing but it is just the difference between the highest call and the futures price. If you click on call difference one, you will get to see all those stocks where which are closest. So smaller the difference, closer it is to its highest call or highest puts. Lower, smaller the difference, closer, bigger the difference, way far off it is, smaller the difference, closer it is. As simple as it gets. So see, we identified BEL manually, but this thing, it easily identifies that for you. What it is identifying that, okay, it is trading half a percentage above its highest call and 5.6 percentage call writers have already unwound. So now this is how you can go ahead and find those stocks out easily, right? Then Vedanta as well, quoting around the highest call and call writers have started to unwind. So now coming to the last aspect, so you can easily go ahead and visit triggers tool in the app and you can use the filter of call difference and put difference and see, how the open interest is changing whenever the stock has break out its highest call and whenever the stock has breakdown its highest put. Now coming to the strategy. So the strategy out here would be very simple. If the position is intraday, you would go ahead with a plain vanilla long call, or a long put. If it is a bullish trade, obviously long call is the better solution. If it is a bearish trade, long put is the better solution. Coming to the positional aspects, if it is a bullish thing, if it is a bullish forecast, that means if it is a bears who are getting trapped, stock trading above the highest call, that is where for a positional forecast you can think about a strategy like a bull call spread, and on the bearish side bear put spread is the strategy to go ahead and try to observe in this type of scenarios. So yes folks, I would say that was it from my side. I hope this video was helpful for you. So if you have anything else apart from this in which you think that we should make a video on, then definitely let me know in the chat box. And yes, that was it from my side. Thank you so much. Happy trading. Bye bye and be a data driven trader.